Hello and welcome to Tcom Investment. This analysis is for Trip.com Group on Nasdaq as of 20th of July 2026 with a share price of $44.19. The full report is on tcom.ca. Trip.com is the leading online travel agency in China. It sits on a net cash balance sheet, and on clean operating earnings it is cheap, which is why the medium and long calls both move up to buy. The medium won an upgrade this run, but the short-term call stays hold. The primary trend is down on the monthly, weekly and daily, and there is no confirmed entry yet. Accumulate on weakness, or buy on a reclaim of the 50-day line, rather than chasing it into the downtrend. The quality here is real. Trip.com is the #1 online travel agency in China across flights, premium hotels and outbound, with the Skyscanner meta search engine and a fast-scaling international arm. It is asset-light, with 80% gross margins and a 25% operating margin. It converts more than 90% of profit to cash, and it sits on roughly $10 per share of net cash. Quality scores 75. On the price, it is cheap. About 13 times clean forward earnings, or around 10 times once you strip the cash, against a warranted multiple near 18. That is a ratio of 0.71, firmly in the attractive band, and there is 35% upside to the consensus analyst target of $60. So why not buy it today? Because the tape has not turned. The monthly, weekly and daily are all in downtrends, the weekly on a support breakdown, and relative strength is weak, down about 27% over 6 months, against a roughly flat market. The stock did capitulate to a $38 low in late June and has bounced to 44, and the daily momentum is curling up. But only the intraday frames have turned. There is no confirmation. The base signal is a buy on value, but our rule caps a fundamental-only entry into a downtrend to hold. The confirmation to watch is a daily reclaim of the $46 50-day line on volume, or a held higher low above 38. The driver is Chinese consumer travel demand, and right now it is neutral rather than a tailwind. China's second quarter growth undershot target, and the consumer is cautious, though travel and experiences tend to be the resilient pocket. Holidays get cut last. A neutral driver does not amplify, which is why the medium and long calls are a plain buy, not a strong buy. Two pressures keep it honest. Meituan is a low-cost attacker taking share at the budget end, even as Trip.com gains internationally. And this is a Chinese ADR, an antitrust posture at the regulator, the VIE holding structure, and the long-dated delisting tail are an overhang. This run we stepped that down from a hard cap to a loud caution. No dated ruling could be confirmed. But it is a real risk, not a resolved one. The risks are loud, and they are the reason the stock is cheap. The bear case sees the shares fall to about $34, roughly a quarter below today. That takes a genuine China consumer deterioration, retail sales negative, travel volumes rolling over, or emerging market currency stress, or a live antitrust ruling, or a delisting scare. The $38 low breaks, and the multiple compresses toward 10 times. Meituan taking further budget end share is a competitive trigger on top. And because the tape is already in a downtrend, a value buyer here can be early, and painfully so. This is a present risk, not a distant tail, which is exactly why the short-term call is hold, not buy. Now weigh the risk against the reward. The bull case is roughly 49% above today, the base case the most likely about 18%, and the bear case a fall of about 23%, so you are risking about 23 to make 49. So, our call on Trip.com Group, on Nasdaq, hold. Remember, this is for education, not financial advice. Always do your own research. This analysis is by Tcom Investment at tcom.ca. The link to the full report is in the notes below. Have a great day.